Welcome to the Homeowners Network podcast, where real estate deals are made and where I break down mortgages, real estate financing, and loan programs in a way that you can easily understand and grow. I'm Ebony Biko, your senior loan officer and mortgage strategist, and this podcast is designed to help homeowners, home buyers, real estate investors, even realtors make final decisions and understand the mortgage process and how to get these deals freaking closed and done. So today's episode is built around the question I hear very often from the homeowners. Should I get a HELOC? And how does it actually work? Well, if you've ever looked at your home value and thought, I know I built equity, but how do I use it wisely? This episode is actually for you. So what is a HELOC? Let me explain the way that homeowners needs to hear it. And to be honest with you, even as a realtor, this is something that you should know and be able to understand it, because this is how you're going to continue to build your business as a realtor, by being a resourceful individual. A HELOC, or home equity line of credit, is not a refinance. And it's not actually even a traditional loan. A HELOC is a revolving line of credit secured by the equity in your borrower's home, your buyer's home, your client's home, your home, okay? So what this means is you're approved for a maximum credit limit. You can draw money as needed. You only will pay interest on what you actually used. So even though you pulled out, let's say $500,000, right? If you're not using $500,000, you're not paying an interest for the $500,000. You're only paying an interest for what you actually used. Now you can pay it down and you can reuse it again. Think of it as like a financial tool, not a one-time transaction. So let's understand how the HELOC actually works and just kind of like do little calculations. So the home equity, this is the way that it is calculated. Your home's value minus what you still owe on your mortgage. So for an example, if your home is worth $500,000 and you owe $350,000, you may actually have around $150,000 in equity. Now, granted, you do have like fees that you need to pay to the mortgage company to get this done, but understand, depending on what you're using a HELOC for, this is very beneficial to you. A HELOC actually is going to allow you to be able to access a portion of that equity while keeping your existing mortgage intact. Especially helpful if, let's say, you have a great interest rate and you don't want to lose that interest rate, right? So this is what this HELOC is for. You still able to kind of keep that interest rate. How HELOC is structured is what people actually kind of get confused by. Most HELOC have two phases, and understanding this is very critical. So first, there's the draw period phase, right? So this phase typically lasts for 5 to 10 years. Now, during this time, you can borrow from the line, you can pay it down, you can borrow again. Now, many programs allows the interest-only payments during this draw period. Then you have the repayment period. So this is the second phase, right? So after this period ends, the loan moves into a repayment. No new draws, principal and interest payments. The structured payments are paid off at a certain period of time. So knowing which phase you're in actually is going to help you plan responsibly. Now, this is what I need you to do for me, right? So when it comes to this HELOC, whether you get a pen and paper, I need you to be able to visualize this. Visualize as a homeowner so I can help you understand this better. So let's say that you're approved for $100,000 for a home equity line of credit, right? you don't receive that money up front. Instead, it's available when you need it. Because the reality is, if you get a loan for $100,000, it is so easy to spend that money. And the reality is, I'm telling you up front, I could spend $100,000 in less than a month, right? Because that's my, unfortunately, that's my lifestyle. It's easy for me to spend $100,000 in a month and sit there and be confused and like, I don't have nothing to show for it, So unlike a cash out refinance, you can easily get that $100,000 and it's gone. Like, it's gone, right? With the HELOC, on the other hand, you're not doing that. Like, you're spending it as needed, and you're spending it as needed, and you're paying the interest on what you spent, not that full $100,000 that's being taken out. So that's the benefit of a HELOC. If you use $25,000 for renovation, you only pay interest on that $25,000 for that renovation versus pulling the whole $100,000 out, and now you paying $100,000 interest, but you only use $25,000. Now the remaining $70,000 stays unused and costs you nothing. When you pay the $25,000 back to your bank, guess what? Your available credit return, you still back to $100,000. So even if your credit score dropped, you still got that $100,000 that you was initially approved for. That is why HELOCs is often described as reusable equity. Repeat that. Hear me out. HELOCs is reusable equity. Now, why the homeowners usually love HELOCs is because HELOCs are commonly used for renovations that increase property value, emergency reserves. HELOCs is good for responsible debt consolidation. If you got a lot of things that needs to be paid off, you can do that with an HELOC. Education expenses, you can do that with a HELOC. Bridge funding, investment opportunities with a clear path and plan in place. Meaning, if you are in the process of trying to, let's say, invest in a business, you can do that. Like, these are things that you can use the HELOC for. So when it comes to the HELOC, it is a great opportunity for you to have as a homeowner. Now, when it comes to the credit, the lender, what they look at, credit score matters, but it's not the main factor. One of the main factors, to be honest with you, is the equity into the property. Now, 700+ credit scores, of course, you're going to get the best rates. You're going to get higher line limits. You're going to get more flexibilities with what you can do with this HELOCs, and just more flexibility as a whole. Now, when you got the mid credit scores, as far as like 600s, you can still get, good approvals. Your rates might be a little higher than someone that has a 700 credit score, and you're going to have conservative limits. Someone that has, a low 600 credit scores, they will have, unfortunately, fewer options, but they do need the strong income and equity to make this deal happen. And then, unfortunately, instead of that 100,000, it's going to be a smaller line. Maybe it's 50,000, but the reality is, depending upon what you're using the HELOC for, you didn't even need all of that up front anyway. Sometimes improving your score even slightly can significantly improve in HELOC. So let's talk about when it comes to the HELOC income guidelines, right? And what you actually need to get this done. So when it comes to the income highlights, right? Lenders may actually want someone that has W-2 income or self-employed income or business income or rental income, retirement income, Social Security, or it could be multiple sources of income. It doesn't matter, because HELOC payments are often lower by as far as like how the homeowners qualify. They may qualify for so many different reasons, whether it's the credit, whether it's the income combinations combined. But the reality of it is, if you want a HELOC and you want to get it done, one of the most important things outside of your credit score is the equity. Sometimes the type of income you have doesn't even matter, because there are so many different loan programs out there. So this is something that you have to be able to understand if you want to get a HELOC loan when it comes to your property. And even as a realtor, if you got a customer or a buyer who's looking to purchase a property, it's really good for you to understand how HELOC programs work, because it might be a situation where they're short with funds on closing, but maybe they have another investment property that they can pull money out. And as a realtor, just understanding how HELOCs work, this is your buyer's down payment. So if you understand that, it's going to make it so much easier for you as a realtor to even close deals. Now, there are so many different HELOC program types. There's the traditional bank HELOCs, which is conservative and credits focused. Now, depending upon how your income is set up, maybe you're someone self-employed, you don't have bank statements, whatever the case may be, you may not be able to go into traditional bank and say, hey, I want to get a home equity line of credit, right? But you come to a mortgage broker, whether it's me, whether it's someone else, they tend to be able to have different lenders that they are signed up with that you cannot traditionally walk right into or even apply online with. They can say, okay, I can do a HELOC for John. I can do a HELOC for Debbie. And they may not have traditional income, but we can still get it done because they have a 700 credit score. Their credit is pretty good. There's no like marks or red flags or anything going in. And this house has so much equity into it. Whereas we may not lend the full $300,000 that's equity is left, but we're willing to give $200,000. So traditional banks cannot do that. But when you have a broker and a non-bank HELOC situation, they are able to offer the flexible and self-employed friendly type loans. Then you have the fixed rate HELOC options, which is just basically payment stability. You have the investor friendly HELOCs, which is repeat use and portfolio growth. And that's why I say as a realtor, you need to understand, if you don't remember nothing else about this show right now, right? Investor friendly HELOCs. You need to understand that, because if you understand investor friendly HELOCs, or even just do like a lunch and learn on investor friendly HELOCs, if they are an investor that has other properties, it is a possibility, if done right and what they've been doing, they can take that money and reinvest it and continue to build their portfolio. So of course, it's going to continue to feed your growth in your closing transactions. But most importantly, it's going to continue to build a relationship, because now you have helped them grow their real estate portfolio just by using a HELOC from one of their properties, which is a home equity line of credit. The goal is matching the right program to your financial situation or your borrower's or buyer's financial situation. So what's really important for you to understand, and this is just giving you a reality check, a HELOC is secured by a property. When used strategically, it can be a very powerful tool. When used carelessly, it can create a lot of financial strain. Education is what makes the difference when it comes to a HELOC, understanding how a home equity line of credit works. So when you think of a home equity line of credit, don't think of just, oh, it's just a traditional owner-occupied home borrower. Absolutely not. This is whoever owns that property, period. Whether it's a real estate investor, whether it's a first-time home buyer that has owned it for 2 years and 3 years or 4 years or whatever and have the equity into it. As long as you own a property, you can get a home equity line of credit. If you are ready to get started and you're thinking about buying, refinancing, investing in real estate, let's talk, right? And you can always give me a call at 312-392-0664 or go to the website just to visit me to see what's going on, which is www.homeloansnetwork.com. But the reality is, forget me. Let's take me out the equation. If you are a homeowner or even just a real estate investor that owns properties, I really, 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 really genuinely want you to understand what a home equity line of credit is and how you can use that to help you grow your portfolio. If you are a realtor and you're listening to this podcast, I need you to understand how you can take this as an opportunity to understand more about HELOC programs so you can be able to help your potential buyers and potential clients understand how they can grow their portfolio. Because I was always taught that you're only good as the information that you know and that was provided to you. With that being said, I would love for you to subscribe, to stay updated to weekly mortgages and real estate insights. Join me every Wednesday live at 7 p.m. Central Standard Time for Wind Down Wednesdays, where I actually answer your mortgage questions and real estate questions live on YouTube and Real Estate Time at the Real Estate Deal Room. So look for that, and it's also going to be in the description. But I'm going to say it again for the last time. A HELOC can be an important and powerful tool, but as a real estate investor, as a homeowner, and as a realtor, it's very important for you to understand how beneficial a HELOC can be. Your HELOC, because it's a home equity line of credit that's in your home, that's in your client's home, that's in your buyer's home. Guess what? Or even if your loan officer listens, your borrower's home, it's nothing but their bank. It's nothing but their asset. If they don't have no money in the bank, understand they're sitting on an asset. They're sitting on a bank. And as long as you understand what that is, everyone is going to win every single time. So once again, make sure you join me live every Wednesday at 7 p.m. Central Standard Time on YouTube for Wind Down Wednesdays. I will be answering every single question, and please invite people because I love questions all day long.